Hey, what's up, guys? Welcome back to the Ninja Wealth Exchange podcast, number 5, where we uncover strategies about building, protecting, and growing your wealth, as well as your real estate and business. We're here to, try to help you guys out, bring people on to make your lives better. I'm Johnny, your host, along with Laura here, and we have a special guest. We have Chris Picciurro, who is a CPA. He's got a ton of acronyms, right? He's got the Personal Financial Specialist (PFS), CPA, of course, Certified Public Accounting, and the ARA, which is Accredited Retirement Advisor. Just super smart guy to go over taxes with you and to kind of talk about. We're going to be going over the Big Beautiful Bill, or OB3. And so, Chris, why don't you fill us in a little bit about your experiences, and then we can go ahead and let you take off and go over some of the things that you can talk to us about.
Well, Laura and Johnny, thank you so much for having me. It's an honor to be on the show and in the podcast. I appreciate your trust, and I look forward to interacting with the Ninja Wealth Exchange community, not just today, but in the future. I've met Johnny a few years ago when looking at another short-term rental. My wife and I have been involved in real estate for a long time, and unfortunately, the rental property didn't pencil out, and by the grace of God, it didn't, because we probably would have lost money on it. But it was great to speak with him, and then stay connected since then. So yeah, we are going to talk today about tax planning strategy and understand the implications of what we call OB3. Now, other people in the industry might call it something else, but I don't get paid by the words. And plus, I like Star Wars. So I figure OB3 is kind of like C3PO, and Obi-Wan Kenobi had a baby, but they really wouldn't have a baby. So maybe they had some type of doppelganger or something. I don't know. Mashup. We'll call it a mashup. The kids like mashup.
Yeah, that sounds good.
So OB3. My role is, I've been a CPA for well over 20 years, and my role now is helping taxpayers legally and ethically reduce tax they pay in their lifetime. And I also collaborate with a lot of tax professionals on doing that. And one of the things we have to understand about tax planning and strategy is that it is, in one of the things I just have poured my heart into, is to understand that it is for everyone. It's not just, I'm trying to unlock these myths about it being just for high income or high net worth individuals. It is for everybody. And just kind of talking through tax planning and strategy, and then we're gonna start jumping into OB3. The thing is that you got to understand that tax planning and strategy doesn't replace tax preparation, and tax preparation time isn't the time to try to do tax planning and strategy. It's think about when you're boarding a plane. When you're boarding a plane, like tax preparation, that's not the time to determine like, hey, I should have stopped and like got a dinner and sat down, or I should have called my buddy. I should have called my friend. You got to get on the plane and you got to go. So you hope you have a good flight. And it's there to complement the tax preparation, not replace it. So, talking about real estate, let's say you're listing your house for sale, and you want to get the best result possible, right? You want to get the highest price. So tax planning and strategy is similar to staging your house. You're not showing a different house. You're not, doing anything wrong. You are just getting the best results. You're creating the feel of what your house could be. Even if you are hiring a interior decorator or renting furniture or what have you. So we want to stage our tax returns legally and ethically. And if you don't pick your tax, your business partner is going to, and that's the IRS. So as I jump into tax planning and strategy, I just want everyone to think about, for us in this world of tax planning and strategy, we created 3 rules. Hey, it's a lot less than 10 commandments, right? 3 things are pretty easy to remember. One rule is that tax flow and cash flow are different. And we're going to jump into that as we walk into OB3. But what that means is that we understand, like, as real estate investors, as business owners, or even as people that have a employment or W-2 job, money comes in, money goes out, but not all your money that comes in is taxable. Not all the money that goes out is a deduction. closing on a piece of real estate, whatever you get at closing doesn't necessarily mean that's what you're paying tax on. So tax flow is something we invented. You probably see my shirt if you're watching, is the tax burden or benefit of all your financial decisions. So that's number one. Number two, tax agencies are your involuntary business partner. So the IRS is my business partner.
Mhm.
If you live in the state of Wisconsin, I just spent a decent amount of time in the state of Minnesota. Hopefully not enough that I owe Minnesota tax, because I know that tax rate gets up to over 9%. That's your business partner. And just like if you created a partnership with someone, your operating agreement states each partner's share of the business income, deductions, credits, etc. You are in partnership with the Internal Revenue Service as a taxpayer. They're going to pick the tax unless you choose to pick that. You choose to pick the tax based on the actions you take. So I'm just, mentally understand tax agencies are involuntary business partner, and tax laws are written to encourage or discourage certain behavior. That behavior could be financial. It could be social. It could be environmental. And we're going to touch on some of these things today. And then, and then the third rule ties into tax planning. Your tax return is a four-letter word, but not a bad four-letter word. Your tax return is a verb and not a noun. Your tax return, if you're thinking about it, shouldn't be something that just gets done at the end of the year and you didn't think about it at all during the year. Then you're going to, for those listening and watching that had kids, remember when you had that child that complained they didn't even get a bigger enough scoop of ice cream, or that their sibling got, a new Matchbox car? And we would say as parents, you get what you get and don't throw a fit. So if you don't like the tax, if you don't like your tax return result, and you didn't do any type of proactive planning and talking to your tax professional, I might upset you within 8 minutes of this show, but you get what you got. So you get what you get. Don't throw a fit. But remember, our windshield is a lot bigger than our rear view mirror. So let's move forward and let's think about what could we do. And this timing of this is great. We're jumping into the fourth quarter of 2025. I believe your tax return. So back to the four-letter word, your tax return is a verb, not a noun. It's something that should be thought about during the year. So implementations do tend to go up a little bit in the fourth quarter, but it's something that you should be thinking about. So as we think about those three laws of tax planning, we can now absorb OB3, read between the lines, right? Laura, Johnny, are either of you football fans at all?
Yeah.
Okay.
Kind of.
So, Laura, what team? I know where you live, so I don't know if you're a Packer fan or if you're transplanted.
Of course, yeah. Packers, yeah.
They're pretty decent. So what? Yeah. So the Packers, when they're on offense, they come into the line of scrimmage. What do? They have a play. They read the defense, and they either audible, shift, or they run the play they had. So the thing is, think about okay, let's read the defense. Let's think about your situation right now. If the year ended last month, where are you at, and what can we do moving forward? So OB3, big, it was a big change, and understanding that tax laws are, like I said, written to encourage and discourage certain behavior. It really doesn't matter what administrations in the White Office, who has a majority in Congress, et cetera, et cetera. What matters is what are the rules? And let's read the defense, read the rules, because not too many people do that. That's the role of your tax professional, to help read the rules. But you also have to, as a taxpayer, you have to do your part too. You have to be a willing participant. I wish if I was Mickey Mouse and Fantasia and I had this little wand, I could, my kids are older now. We don't go to Disney World, but we used to, wave that wand around and make everything great. That'd be awesome. But we need willing participants. So OB3 passed. A lot of interesting provisions. There are things in OB3 that are extensions of things that were passed during the last major change, which is Tax Cuts and Jobs Act of 2017. There are things that got that are new now, and there are things that each presidential candidate spoke about during the election time. I'm sure everyone misses all those commercials, but election and said, okay, how did this actually get implemented? So, but yeah, OB3, one big, beautiful bill. So let's jump in. We're going to start, and I know we have a lot of real estate investors. I know we have a lot of business owners, and we're going to talk about that. But let's talk about some of the personal or individual tax provisions that changed first. So, and again, interrupt me with any questions. I'll probably sneak in a sip of water at that time. But yeah. So what changed? So what are some of the things that are new here in 2025? So they're effective immediately. It's very rare. Excuse me. In tax professionals, we did our own little happy dance, and we were lighting off our own fireworks on 4th of July when the OB3 passed. Not necessarily because it passed. It was July 4th. Many tax laws passed about December 22nd, and everyone's left scrambling. So this allowed us a lot of time to prepare. And there's some, and there are some things that are autumn, in 2025, brand new, and then some things in 26. So I try to keep track of a lot of like the vibe and what's going on with tax law changes. The first thing I'm going to mention here in 2025 is something that I didn't see coming. So there's a new car loan interest deduction. All right. And this is a deduction that's available for non-itemizers. So as we know, each taxpayer either itemizes their deductions on what's called a Schedule A, or they take the standard deduction based on their filing status. Before Tax Cuts and Jobs Act, approximately 30% of taxpayers itemized. After Tax Cuts and Jobs Act, only about 10% of people itemize. So some of these things that were like itemized deductions didn't help that many people. I think we're going to have a spike in itemized deductions for something. Something we're going to talk about in a couple minutes. But so some of these deductions were meant for non-itemizers. Now, in the tax world, you might have heard your tax professional say above the line deduction, and it's like, oh, okay, let's we speak English here. Like, what's going on? What does that mean? Above the line means it's a deduction that is on your tax return before your adjusted gross income, or you might hear of AGI or MAGI. We might get into, hey, I was really nerdy when I was little. I love Dungeons and Dragons. I probably would still play if I had the time. So if you did Dungeons and Dragons, you know what a MAGI is, you know what a wizard is. We'll stay.
Yep,
so I've already outed myself as a Star Wars fan and a Dungeons and Dragons person. That's all right. But the modified adjusted gross income is your driver in many of your deductions and your phase outs. So when you heard above the line as a taxpayer, that would mean, okay, that is for modified adjusted gross income. Well, some of these deductions are not itemized deductions, but they're not above the line deductions. And it's funny, I've been talking to some tax professionals like, what the heck are we going to call these deductions? I was thinking, now this just might be, and I don't, it really, everyone pays tax no matter how you grew up. I grew up, in a very Catholic household that I enjoyed. And I call these purgatory deductions, but I know that's not the most politically correct. So we're going to call them between the lines deductions.
Nice.
It's not above the line and it's not below the line. It's not itemized. So we'll call it a between the line deduction. So that's what the car loan interest deduction. So even if you don't itemize your deductions, you could still take advantage of this deduction. It's up to $10,000. Okay, $10,000. Couple of caveats. The vehicle has to be assembled here in the United States. You have to have the VIN number, and you have to have that when you file your tax return. And it's supposed to work with those VIN numbers are going to be sent to the Internal Revenue Service. We hope it does. And there's something called a phase out. What a phase out means is that if my income is above that a certain threshold, then I'm either not eligible for the deduction or it gets reduced on a sliding scale. So, if you were a big kid like me when you were growing up, now I'm only 5'11". So unfortunately I stopped growing taller when I was in 6 foot on a good day. I went to the doctor. Last time I went, I had tennis shoes on. They put me up at 6 feet, but I'll call 5'11".
Nice.
But when young kids start playing tackle football, if you were like above a certain weight, you have to play on the line. You got phased out of playing quarterback. You got phased out of playing running back. So that's the way to kind of think about that. That starts phasing out at $200,000 married joint, $100,000 single, and a couple other things. It has to be a purchase. So it can't be a fleet vehicle. It can't be a lease. It can't be from it can't be a related party loan. And it's got to be a personal vehicle. So that's a pretty generous deduction. It's got to be under 14,000 pounds of the gross vehicle weight. So that's a pretty generous deduction, coming through immediately here in 2025. And now, and I'm not going to go through every rule about, but I just kind of make you think about this is, okay, who is the federal government throwing a bone to here? Oh, I'm from Detroit originally, been in Nashville, Tennessee for a little over 9 years. Maybe they're throwing a bone to the big three, right? Or remember, what were some of the thought, like, again, with the Trump administration, what were some of the things they were pushing was manufacturing in the United States. So the caveat is has to be assembled in the United States to get this deduction. So car loan vehicle deduction, I think that might be something that a lot of people take advantage of.
Yeah, that's a good one.
So next one.
Quick question on that, actually.
Sure.
Is that something that our tax preparers will have, like a list of vehicles that is acceptable and not acceptable? I know they're going to be looking at the VINs, but
Right.
I mean, like Hondas are almost fully assembled in the United States, right? So
Yep. Hondas. I know Hyundai. I've been living in Nashville. We drive through Alabama all the time. There's a big manufacturing plant there. Yeah. So what I've been told I'm very blessed to be part of a bunch of trade organizations and teach for the National Association of Tax Professionals. So what I have been told is in my role there is that the VIN number actually identifies where it's manufactured. So similar to like we all have social security numbers, that indicates either, where you did a lot, like where you were born or time frame. Yeah. So the VIN number the VIN number itself will identify if it was assembled in the U.S. And then I would, you're mandated to e-file a tax return. So if you're taking the deduction, we'll have to put the VIN number in. And if someone has the wrong VIN number or doesn't match, the IRS will reject that tax return.
I see. Okay.
But yes. Yeah. Great question though.
So Google says VIN numbers that start with 1, 4, or 5 are U.S. made.
Hey, I like it. I trust Google. All right. So next thing on the individual side, no tax on overtime deduction. Very hot item, right? So that's something that's a deduction up to $12,500 for individual for taxpayers. So married joint up to $25,000. We know. So this is going to get really, really tricky because there's a phase out on this as well. Now, Laura and Johnny, wouldn't it be nice if we had the same phase out number for all these deductions?
Yeah,
it'd be great. But they're all different. It's a mess. This phases out $300,000 for married joint, $150 on single. And you have to have qualified overtime, pay under the Fair Labor Standards Act. So it's going to get reported on a W-2, and I believe in 2026. Now this is something that, again, this is going to be one of those things where there's probably a little more ambiguity around, and because think about your W-2 typically doesn't say, like, it tells you your wages, doesn't necessarily say how much is your overtime. But I believe that, for 25 here, I think you're going to have to look at pay stubs. I think, we just did on our, shameless plug on our Teaching Tax Flow YouTube channel, a walkthrough of the new W-2. But I think that takes effect in 2026 where it breaks out the overtime. So 25 is going to be a Wild West a little bit. If you did get paid overtime, my best advice is to just make sure you download that last pay stub, and then it'll be probably a voluntary just filing and saying, hey, X amount was overtime. Eventually, the overtime is going to have to get reported to the IRS through payroll companies. But you got to realize this happened in July. A lot of these forms, it's so hard for them to pivot and make a new form. And that's going to be reported just like the car loan interest deduction. There's a new form the IRS created this year called the Schedule 1-A that's going to reconcile all of these in between the line deductions. So now, what's something we heard about during the election about a year ago? Oh, geez, both parties kind of liked having that senior deduction. Why? Because they've got nothing better to do than sit in line and go vote somewhere. So they wanted to get those votes, right? They wanted to get the
absolutely. Now,
I like the term mature age. So, the fact that the IRS just called it senior makes me feel a little better about myself. But the senior deduction, okay, so here's the situation on that. When we were absorbing, now thank goodness so we could tape things, right? But when we were absorbing all of the rhetoric from both sides of the aisle, they're saying, well, we don't want to tax Social Security. Well, then guess what? Social Security is still taxable if you have other income. There's certain phase outs. So the bone that was thrown to seniors is that up to $6,000 of their taxable income every year could be not taxed on the federal level. Now, we got to look at Minnesota because they're kind of meanies over there. I don't think they're going to like this. We got to look at state tax conformity, right? I don't know about Wisconsin for lore. Of course, you gentlemen are much, much younger than the threshold for this deduction, which is 65 years of age. But you, so that deduction is up to $12,000 for married filing joint. And yeah, you could just take that as a deduction off your income if you are a senior, 65 and older. This is a temporary deduction.
Nice. That's really cool, actually.
Now, here's the problem. There's a phase out. Now, this phase out is $150,000 married joint, $750 single. But Johnny, I agree 100%. In fact, one of the things we're going to do for our YouTube channel is I'm going to walk through a strategy for seniors to move almost $50,000 of income tax free. And what the thought would be is if you're under that threshold, right, and you could if you could take. Basically, if you could absorb $12,000 more of taxable income and still stay under 150 in your married joint, why wouldn't you, even if you don't need the money and you're over 65, start taking money out of your retirement plan each year if it's tax-free? Or better, if you really want to get fat and sassy, convert it to a Roth IRA and let it grow tax-free. And this deduction's in play for 25, 6, 7, and 8. So there's a temporary deduction for 4 years. 4 years. Isn't that the term of presidency? Yeah, maybe this was a compromise. And you don't know if the Trump administration stays in the White House for another 4 years after this, I think this deduction might become more permanent. But we've got to see what happens. But still, $12,000 a year, that's almost $50,000 of money that you can get out of your retirement plans or have capital gains or recognized income tax-free if you play your cards right. And that's why I'm so passionate about, again, tax. I don't consider $75,000 as a good living as a single person, 150 married joint, but I don't consider that super high income or super high asset. So that's why what I'm saying is, tax planning is for everyone. And I would argue that the moderate to lower income and asset households could benefit more because an extra $2,000, $3,000 in their pocket could be a decent amount of disposable income compared to someone that's taking a lot more. So. Yep. So anyway, tax. So next one, expanded child tax credit. Child tax credit was tapped out at $2,000 per child. So what's the government saying? Hey, go have fun and have more babies. You get an extra $200, right? But the child tax credit is now expanded to $2,200 per child, with the refundable portion being $1,400 per child. Those thresholds are a little older. And I was remiss. I should have mentioned this. Remember I said the VIN number was required on the deduction for the auto loan interest? I'm going to backtrack. For the temporary senior deduction, a Social Security number is required. So no ITINs. And for the expanded child tax credit, a Social Security number is required for that. So that's $2,200, up to $2,200 per child. And here's a nice thing. This is indexed for inflation. Now that doesn't seem like a big deal when okay, it's $2,200 for 2025. Let's say it's $2,300 for 2026. Big whip, one extra $100, right? Nothing to dance around about, But here's the situation. If things are not indexed to inflation, you run into the situation like this. Long-term capital. So if you have a capital loss, you don't have any capital gains, you can only deduct as a married filing joint couple up to $3,000 of capital losses, only $1,500 of capital gains. That $3,000 has been the same number since I had a hairdo. So the thing is, it's never been indexed. So the fact that this is indexed, I think is pro-family. In other words, what I'm saying. Another thing, standard deduction that we're now used to, kind of like if the Tax Cuts and Jobs Act expired, we would have went back to the pre-tax cuts and job tax standard deductions, which is about half of what we have now. A standard deduction says the first X amount of dollars is tax-free. No, and for a married joint couple, it's about over $31,000, single, almost $16,000. And that was going to get cut in half if this law didn't pass. But people would have not known. It's like having a teenager. Yeah, your bedtime was 9 p.m. Now it's 10 p.m. It's 11 p.m. because you're a senior. And you know what? Tomorrow it's going back to 9 p.m. Sorry. People would have been shocked. They wouldn't have realized it. It's a big deal that the standard deduction was made permanently high. In other words, at least when we say permanent, it means till maybe there's another president in place and another Congress and they change it again. But so standard deduction is high, still high. I'll go through a couple more because I really do want to spend some time on our business and real estate. But again, with these other deductions, it does allow more money in the pocket of business owners and real estate investors. So it all kind of works in a big circle. The child dependent care tax credit has increased up to 50%. That's kind of based on income. The dependent flexible spending account has increased. So if you are working, right, and you have the option to put money in to a FSA, flex spending account, pre-tax through your payroll, that limit is expanded because if you take the child tax credit to pay for your child daycare expenses, that's limited based on income. So you might as well fund the FSA, and then any overage you could take the credit for. The max is $7,500 for a married joint. And, I don't know too many daycares that are only $7,500 a year, but hey, at least they threw us a little bone.
Yeah, definitely.
That's something. 529 plans. Now, I'm a big fan of 529 plans because they continue to be expanded, the use of it. So 529 plans. Now, before that was, all right, congratulations, Jill, you just had your baby. Let's let Granny and Gramps throw a couple bucks in an account so mom and dad can't blow it on stupid stuff because we think you're going to go to college even though you're a week old. You're just the smartest, cutest kid we've ever seen. So all these 529 plans were started, and we have them too, right? Yeah. But all the 529 plans were started, and money was put into them. But when they started, they were very restricted on how do I take the money out of that as a taxpayer tax-free. And now it's it's been further expanded where up to starting, I think in 26, up to $20,000 a year per child could be taken out of the 529 plan tax-free and used for any type of private K-12 expenses. So let's say you have someone, let's say you have a child that's in a private high school and you've accumulated a lot in the 529 and you're thinking, yeah, I mean, I have clients situated like their kids in like 10th grade. They've been very, disciplined financially, and they've got like $300,000 on this 529 plan. Like, unless this kid's going to MIT or something, we're not going to need that. Yeah, no offense, right. I'm sure the kid's smart. But so I'm like, well, you're paying $20,000 a year for private high school. Why, after tax dollars? Why don't you just take the money out of the 529 for the next few years? You'll still have $250,000 in this thing, and you can do it tax-free because the child's in a private high school. So that's been really nice that the 529 plan has loosened up, where we can use it for more expenses. We can use a higher amount, and you could also use it for tutoring, test preparation, or credentialing exams, like a CPA exam or an enrolled agent exam. So if you have that same high school student that's taking their SAT and they want some tutoring, or they want some, what if you have a child with special needs or needs a speech therapist that goes beyond the school district? The point is 529 plans, they're expanded on how you can take money out of that and use that money without having to pay tax on it. Oh, one thing outside of OB3, I think it was Secure 2.0 Act. There's way too many tax acts, who knows? But one of the things we need to think about is if you have a dormant 529 plan. So let's say Johnny created a 529 plan, and Johnny Jr. is a rocket scientist and never needs the money. And there's like $30,000 in it. Johnny Jr. got scholarships through his whole life. and you're like, dang, if I take the money out of this, I put $10,000 into it, I'm going to pay I'm going to get taxed on 20 grand and a 10% penalty. Well, now you could take up to 35,000 out of a 529 and you can start converting it to Roth IRA money. So think about that. Now, again, work with a financial advisor and a tax professional. Don't just go out there like the Wild West and start shooting your guns around and without having a target, right? So think about, but just, there's always a solution to someone's situation, but you have to use the right people. So work with the right people.
No, that's actually really cool. That's really cool because that was my thought is like if you put too much money in there, what are you gonna do when the money's just sitting there? I mean, it's gonna be sitting there. I mean, could you use it for your grandkids? Yeah, possibly. Could you use it for further generations? Possibly. But the thought is that could you? I mean, we're wealth people, right? So or people that are trying to create wealth. So could we be using that money to create additional wealth for the kids? I think that's really, really cool that we can actually move it over to Roth IRA.
Absolutely. So you can convert it. There are some, so your conversion's limited to your annual Roth contributions. That's what I'm saying. It's a really good option. The 529 has to be open for at least 15 years, but it's a solution, so let's think about that. And it's pretty cool. I'll breeze through a couple more of these bigger picture. We know we're going to have the Trump accounts. Still learning about that. We know that an employer can contribute to that. So I'm not, other than knowing it exists, that the whole tax preparation and planning community is still absorbing it and trying to figure out how that's going to get reported, how that's going to work. I didn't want to ignore it, but we just don't have enough guidance at the time of this taping to really render any type of planning or opinion on it. Tax rates have been made permanent. So that 10, 12, 22% rate, they were going to sunset after Tax Cuts and Jobs Act. So a lot of people are thinking like, sunsets are pretty nice. I thought I liked sunsets. No, sometimes they're crappy because that means that, a tax law is going away. And we got to think back to the Tax Cuts and Jobs Act of 2017. When the Trump administration came into office, they passed the TCJA, but they had a compromise and they had to say, okay, fine. We could drive in the car and put our radio station on. But once someone else comes in the car, we're going to have to turn that off. But they never expected someone else to come in the car, meaning they never thought they'd lose a second term. So a lot of these things that were going to sunset, they figured, we'll deal with it later. Well, guess what? It was about to sunset. And then they came back in and took the office again and now made them permanent. But before, we were going to see tax rates in the 2017 levels, which in general, people were going to pay about 20% more in tax. And we didn't, we didn't realize. So the good news for our taxpayers, permanent extension of those tax rates. And the people in Wisconsin and Minnesota were jumping around and dancing for joy when the next thing passed. I just know it. The SALT tax deduction, right? State and local income tax. So and that's why I think we're going to have more itemizers coming up. Under the Tax Cuts and Jobs Act, well, remember, it was a pretty divided. And guess what? The people in California and New York and Illinois and Minnesota, they got on Santa's bad list. So the Congress said, we don't like you anymore in 2017. You guys didn't like what we had to say. So we're gonna put a $10,000 SALT limit on, and meaning you can only deduct up to $10,000 of your state and local income tax. So if you lived in, it's fun to pick on California. It's funny, when I was up in Minnesota, we were talking about how the max rate's 9% or higher. And in these tax professionals that I was teaching, there's 70 of them, amazing people would get so upset. I say, but guess what? Someone's got to pay for this amazing weather. And then they just get more mad. But wow. But let's say you're in California, let's say you make $150,000, you're married joint, $150,000 a year of income. That's a good living, but that's not, if you live in Southern California, you're probably just scraping by, especially if you have kids in dance or travel sports. So let's say that means you're paying, let's say, $12,000 of income tax. Let's say your property taxes are another $10,000. You're paying $22,000 of state income tax, but you could only deduct up to $10,000. That's SALT tax. Now you're going to be able, as a married joint couple, to deduct up to $40,000 a year in state and local income tax. Wow. and 20,000 for single. And I'm going to drip in to the business side of things. There's a strategy for business owners called PTET. I don't want to get too technical and get all these acronyms going around, and everyone gets a little crazy with them. But there was a strategy that let's say I was in California, I had $200,000 of business income. I was going to pay a $20,000 California state tax approximately. My business was going to basically 10% of my net income was going to go to tax, and I didn't get a deduction for it. You can make a pass-through entity tax election if you're an S corp, or if you're a partnership, and have the business pay the tax, but you get a deduction for it on the personal return. The point is, that was under fire, that strategy. It was basically a workaround. But the federal government said, you know what? You created such a workaround. That path, actually, there's some, just like a path in the woods when you were a kid. You'd go through the woods, and for no reason, there's just like a path because a bunch of people rode their bike and their feet were on it. That path's good enough to be a real path. So the point is, now, if you're paying state and local tax, if you're a business owner, real estate flipper, et cetera, there is a path, no pun intended, for you to deduct those state taxes no matter what. Now you have the higher SALT tax deduction, and you have the permanency of the PTET, pass-through entity tax selection, that you can make. So SALT deduction, big one. Johnny's, I'm sure, happy. The mortgage interest deduction is still in play. You can now, starting in 2026, deduct PMI, which is a private mortgage insurance interest.
That's sweet.
Yeah. And which is great because rates are higher. Sometimes, most of us in our life had to pay PMI because we wanted to get into a property. We wanted that home ownership, the American dream. And, for a while it wasn't deductible. So now it's deductible. So that's pretty cool. And, there's some changes to charitable contributions starting in 2026. But guess what? We're not going to talk about that right now because I'll come back on the show in a year and we'll talk about the 2026 changes. Even though I talked about a couple of them, but just be aware there's some charitable contribution changes. And then on the federal level, our miscellaneous itemized deductions, what we call they used to be called 2106 expenses. Tax Cuts and Jobs Act said, guess what, you guys? You're a bunch of cheaters. You could put deductions on your tax return that weren't eligible. Like, I love police officers, I love firefighters, but it was miraculous that every EMT bought 5 new complete uniforms every year and wanted to deduct it on their tax return. So anyway, all those unreimbursed employee business expenses, with rare exceptions, did go bye-bye, and now they're permanently bye-bye. They burned the ships on that. Sorry, Charlie, at least on the federal return. Set up a reimbursement program through your employer and take less W-2 wages to be tax efficient. So, by the way, the educator expenses. One last thing on this, educator expenses. My wife's a teacher, but now she's a school counselor. She can now deduct up to $300 a year. She could still deduct up to $300 a year above the line for expenses. And this what used to be just for classroom teachers. They expanded to coaches, administrators, extracurricular activities. So that coach that has to go buy basketball equipment or whatever now can deduct up to $300. Now, my wife likes this deduction because it's kind of funny. Every time she goes to Target, she needs something for school, right? Anyway, that's a personal problem. I'm just teasing. Yeah. We have a great marriage. Or else we're on the live show.
My thoughts are is that like I know a bunch of teachers too, and coaches as well, where they're out there and they're buying extra stuff. Like they're like, my classroom doesn't have this, but they need it, so I have to go get it. And like I've had coaches where they're like, my player doesn't have shoes. Like I need to go get him a new pair of shoes. And so you got people coming out here, and these people are really, really helping other people. So I think that's super cool too.
Absolutely. And I think about, a lot of middle to lower income communities where the coaches are putting so much time in buying things. I know coaches that'll rent a gym or drive kids, buy meals for kids, just do so much for these kids that need it. We need to keep kids engaged in that kind of stuff. So
absolutely.
So those are the major personal changes with OB3. Obviously, a lot to digest, but hey, there's opportunity for everyone. All right, let's get into the business and real estate, the bigger deductions for businesses and real estate investors. And they kind of tie in with each other. Probably the one that got talked about the most was bonus depreciation. What in the heck's bonus depreciation? Sounds like something you get on a game show or something. Bonus depreciation. Well, what that is that means that if you buy personal property that's being used in your business, that could be machinery, equipment, it could be a vehicle. Oh, by the way, I'm going to go on a side note. Buying a vehicle is not a tax planning strategy.
People do it all the time.
I know. It's like, it's an excuse to get a new car, and just be honest with yourself and your spouse. But there's a tax advantage. So bonus depreciation allows you to deduct something that traditionally you would deduct over 5 years, 15 years, maybe 7 years or more, year one. Now, remember I talked about cash flow versus tax flow, so I want to be careful about something. You might buy a piece of equipment. Let's say you're a farmer and you buy a new tractor, and you could deduct it over 5 years. If you deduct the entire amount of the tractor year one, that's good. However, you might be paying on that tractor for the next 7 years. You don't get a deduction for paying off debt. You'd get a deduction for the interest. And that sometimes creates a cash flow versus tax flow situation where a taxpayer is like, well, I made $20,000 of tractor payments this year. Really talking that accent. Why do I only get a $5,000 deduction? Well, you took the deduction 3 years ago for the tractor. Oh, then screw. Oh, I got to be done. Oh, then okay, I'll just trade it in. Well, now you got to recapture that depreciation. So my point is, bonus depreciation could be really, really good. However, talk to your tax professional about if it's appropriate to use it in a given year, and understand that bonus depreciation is automatically given to you. So if you bought something, when your taxpayer enters that into their tax software, it's calculating bonus depreciation on any eligible asset. You don't have to take it. You can elect out of it if you want, but there's plenty of times when it might make sense. So anyway, bonus depreciation is here, 100% now. Remember Tax Cuts and Jobs Act? They got a little wanky on us. It was 100%. Then it was 80% in 23, 60% in 24, 40% in 25 here, and then it went back to 100. But the cool thing is we've got a transition rule. So in 2025, assuming that the asset was placed into service after January 19th, don't know if that was a tip of the cap to the Martin Luther King holiday or just the day after my birthday. Who knows? You can elect to take the 60, 40, or 100. So yeah, just be wary of the depreciation recapture, but bonus depreciation is a good option for many, many people. It also now, real estate investors, bonus depreciation is the engine that powers cost segregation studies. So you probably hear a lot about cost segregation studies. Man, if I had $1 every time I was at a holiday party, and you hear a real estate investor yeah, I bought these property, I just cost segregated. I'm like, well, what does that mean? I don't know. I heard it. Okay, I sound good. But the thing is, think about, so cost segregation studies are going to be much more popular. And I really like cost segregation studies. Our private CPA firm, we probably see 150 of them a year. They're a very powerful tool for real estate investors. But the cost segregation study allows you to reclassify a portion of real property into personal property, and based on whatever the bonus depreciation rate is in the year you acquired it, you get that deduction. That's why 100% bonus depreciation, it's going to greatly affect the short-term rental investors that are short-term rental loophole, tax loophole investors, and that sort of stuff. So yeah, bonus depreciation, think about it. Bonus depreciation is the engine that drives cost segregation studies. But you got to put gas in the engine. What does that mean? It means that to be able to take a cost segregation study and offset income, you either need to be something called a real estate professional status, you have to be the short-term rental loophole, or you have to have other passive income. We'll talk about that next time I'm on the show, hopefully. All right, qualified production property. So there's now a new special 100% deduction for constructing some large manufacturing, production, and refining facilities. So theme, if you're building a manufacturing facility in the United States, you ultimately could take bonus depreciation on the entire property. It has to be placed into service before you pop the cork on your champagne in December of 2030, rather. So it's got to be placed into service before December 31st, 2030. Do I think a lot of people are going to be doing that right now? Probably not. Not too many people are thinking about it. But what are we doing? Remember, tax laws are written to encourage and discourage certain behavior. Business owner thinks, okay, I need a place to manufacture. We're going to check Laura out now, right? We're going to go up to Milwaukee, home of Harley Davidson, and say, you know what? We're going to manufacture parts for Harley Davidson. We're thinking about building this facility overseas, but we know we can get 100% deduction if we build it here in the States. So we might build it in the States. So this might influence decisions. I don't see this being a big factor here in 25, but it could be in the moving forward. So now, everyone knows you have those cousins that you love, and you have those cousins that you just roll your eyes at Christmas or Thanksgiving when they're over. Most of my cousins I loved. Of course, I come from a big Italian family, so I probably got 10,000 cousins I don't even know about. But the cousin, why am I talking about cousins? Bonus depreciation has a cousin. At least I call it a cousin. I'm coining it. Or I did a couple of years ago. Who knows if anyone else has stolen it from me? But Section 179 depreciation is still in play with OB3. And it actually got expanded to up to $2.5 million. And 179 deduction is an immediate depreciating of an asset, but you have to elect into it. So that's why Section 179 is still in play with OB3, and bonus are cousins. Bonus depreciation you automatically get, and you have to elect out of if you don't think you need it and it's going to be more valuable in the future. Section 179 you don't get, but you have to elect into. And you can utilize those two deductions in concert to get the best result possible. So anyway, that's $2.5 million now of qualified property, and it's indexed for inflation. So I think that's a win for people.
Yeah, definitely huge win.
All right, you guys are gonna boogie down here to Nashville for the next change. It's called the HITS Act. The HITS Act is part of OB3, and HITS stands for Help Independent Tracks Succeed. So now music productions like albums and singles and sound recordings, gosh, if you're me, you remember CDs and tapes. Anyway, if they're primarily carried out in the United States, this includes film and television, theatrical performances, you can deduct up to $150,000 per taxpayer per year. So the point is, if you are a musician and you're producing in music or any type of movie or whatever, instead of you having to, let's say you built out a studio or you put a lot of money into something, instead of having to write that off over time or amortizing it or depreciating it, you can now deduct it immediately. So point is, if you're a musician or an artist, definitely talk to your tax professional about, can you immediately deduct some of these expenses that you could not immediately? They're always deductible. The HITS Act allows you to deduct it immediately instead of writing it off over time. So
what if you're podcasters, Chris?
You know what? I've got to dive into that. That's a great question. I feel that, a live theatrical production, you're a live podcaster. I think I could find a way to get it in there.
Nice.
Oh, good.
Or you just start singing. I haven't heard your karaoke voices yet. You don't want to hear mine. But then it's a live theatrical performance. Real quick. So for business owners that are highly leveraged, like automobile dealerships or RV dealerships or real estate investors, there was a limitation on business interest. It's called, and where you can only deduct a certain percentage of your business interest as part of your profit and the rest carried forward. Well, now OB3 said, you know what, that we were being meanies. That wasn't nice. So now when you calculate your adjusted taxable income, you get to add back depreciation and amortization when calculating your business interest deduction. So all that means is that if you are a larger investor, you are probably limited in the amount of business interest you could deduct. And now that limitation has been lifted for a lot of people. So
Nice.
I know I'm hitting you guys up with a lot of stuff here, but I'm hoping that the listeners could just say, does any of this kind of pertain to me? And then I have to have that conversation with my tax professional at that point.
Yeah, absolutely.
Research and development. So there's a research and development credit, but research and development had to be capitalized and amortized, written off over 15 years. So let's say you were and so if you put, I don't know, if let's say you put $10,000 into a research and development project, you would have to deduct that, like I said, over 15 years. Well, now, if the research and development occurs in the United States, you could, starting in 25, you could deduct that immediately. So that's kind of nice. And guess what? You can go back up to 3 years, and if you amortize that R&D expense, you can go back and immediately deduct it and amend your tax return. So if you're listening or watching and you have research and development expenses that you capitalized because your accountant said you have to, and you told them they're a meanie, but they were right, this will reverse that. And you have to determine, should I go back and amend my tax return and take the deduction and get some money back in my pocket? So pro business, that was nice. So yeah, couple other tidbits that we're excited about. QSBS stock has now, that stands for, oh gosh, not another acronym. So on our podcast, my co-host got so annoyed. I'm like, why did you just make a little funny noise or jingle whenever I use an acronym? So he did, which is kind of fun.
Nice.
Yeah. So QSBS, qualified small business stock. If you are a founder of an organization and you're thinking about exiting in the next 5 years, definitely talk to your tax professional. Some tax professionals might know this as Section 1202 stock, but ultimately, for many founders of organizations, they can either elect to be taxed as a C Corp, or maybe they're already a C Corp, and they could potentially exclude up to $15 million of capital gain when they sell their business. This is a huge one. I think it's going to be in the next 5 years. If I could buy stock in this rule, which is impossible, I would buy it. So QSBS stock, for people that are thinking about a nice exit in the future and they're worried about their capital gain, if you qualify, I won't get into all the technical parts of it, but if you qualify, there's an option to potentially exclude that from tax.
That's super cool. That's super cool. I think that incentivize people to create businesses as well. Yeah.
Absolutely. We actually and I sound like a shameless plug, but we had on our podcast, we did a whole episode just on this topic alone. We had an expert come in and he's phenomenal. So if you have this situation, talk to your tax professional. If the tax professional is not necessarily aware of what QSBS is, reach out to me. I'm happy to send you some resources. Absolutely.
Sweet.
Hey, remember, guys, when we would get the knock on the door and that really pesky person, even though the neighborhood had a sign that said no solicitors, but they knocked on your door anyway. And yeah, when the Girl Scouts were selling cookies or a friend of the Cub Scouts were selling popcorn, we thought it was cute. But then you got that guy selling windows, Oh, gosh. But guess what? He would tell you that you got a tax credit. Well, first of all, don't take your tax advice from people selling windows, blinds, water heaters, etc. And the government didn't like those people either. They're on Santa's bad list too. So clean energy credits are pretty much gone at the end of 2025. So the clean vehicle credit, used clean vehicle credit, which again, IRS, really rude. They used to call this used clean vehicle credit. I prefer pre-owned vehicle credit, but that's all right. I'm more PC. Commercial clean vehicle credit, all those are gone at the end of 2025. So, and you know what? A lot of those credits were in my category of all hat, no cattle, meaning, oh, this sounds great. We get to deduct our new furnace. And then when the person gets their tax return, the max is like $200. Like, right. What are you going to do?
Is that part of the like electric vehicle deductions when you buy them?
Yes, the clean vehicle credit ends. Yeah. Actually, it just ended September 30th. The clean
yeah. Right.
Yeah. The commercial clean vehicle credit. So if we're talking about business purchasing a clean vehicle, that's still available till the end of 2025. So like I said, make sure you now just signing papers to buy a vehicle isn't enough. You have to take ownership of that vehicle. It has to be placed into service. So before you pop the champagne this December, make sure you got that new vehicle in your driveway. If you're getting the commercial clean vehicle credit.
Good to know.
Yeah, interesting. Then there's just so many, changes there. So,
So we're down to like last 5 minutes or so, Chris. Anything else that you really would like us to know before we
Right.
get into our rapid fire session here?
Absolutely. So there's some changes to the 1099K. Those pesky 1099s that you received. So when you were going to the grocery store and innocently buying Girl Scout cookies, but the leader of the Girl Scout troop said, "Don't worry, just Venmo me." And then all of a sudden she's got a Venmo for 30 grand saying, "I did not, what in the heck happened here? I don't ever run a business." Anyway, the thresholds for those 1099Ks for business owners that issue those, it's now $20,000 or 200 transactions. It used to be $600. So the bookkeeping is going to be easier and there'll be a lot fewer 1099Ks. So that thing I think is a win. Our friend, the qualified business income deduction, it's here to stay. You came to the party, you were nice, you helped mom clean up the kitchen, you can stay. So QBI deduction's here to stay, and it got enhanced starting in 2026, where we're going to have a $400 minimum deduction that's indexed for inflation. 1099s, they're going to increase from $600 to $2,000, just like the 1099K. Yeah, I mean, those are just so pesky. And if you're a business, so why does this? I think it takes a lot of responsibility of business owners and real estate investors to say, can you imagine you own a business and you have someone come out once every 3 years to, clean your air ducts and go through or maybe they're the gutter guys and they charge you $605 and now you got a 1099. And it's like, come on, give me a break. So now that's
we had so at our church, we had a gardener that would come out and just till a really small community garden for us. And that was about $800. And we would have to write like a 1099. And it's like, come on, it's so small and it's once a year, right? So this increasing is huge. I think that's pretty awesome.
It needed to happen. Final thing, and then we'll hit rapid fire. OZ, so Opportunity Zone Funds. We had them in the Tax Cuts and Jobs Act. They are now referred to. We had an OZ fund expert on our podcast. Also, I'm stealing this from her. She calls it OZ 1.0. I call it OZ OG, the original one. And now we have OZ 2.0. So any capital gains starting in 2027 can be deployed into Opportunity Zone funds and get a 5-year deferral of gain. There's going to be a special rural Opportunity Zone fund. The point is this: Opportunity Zone funds are here to stay. They've gotten revamped. They went in, got a facelift, paid their plastic surgeon, and now they're ready to roll. So, yep. Nice. Now I don't see a ton of OZ funds in 2026, but 27, be prepared. But why am I mentioning this? You're a business owner. Let's say it's, you're thinking about exiting. You can't get QSBS. Maybe you just hold on to the business for one more year and you might be able to take advantage of deploying some of your capital gains into a qualified Opportunity Zone fund.
Nice.
It all comes down to planning.
Yes. Right. That's why we got you here.
Absolutely.
All right. Cool. So thank you so much for all the information. It's like for sure we're gonna have to watch this again a couple times to absorb all that. So moving on to the rapid fire questions that we ask all our guests here.
All right.
You ready?
I'm ready.
All right. So starting off, what's your one ninja skill that you're really, really good at that, you're just super good at?
I think that figuring out what the pain point is of a taxpayer. And even though I might not think that's their biggest pain point, I have to address it, so they can understand that I'm listening and they could trust that I care about them, and then address something else. So just like I'm sure, if you've got a mortgage applicant and they're very concerned about their income, but they've got a lot of income, but maybe their debt, maybe they're, something else on the credit report's a problem that they're not even aware of. but you've got to, so yeah, I think understanding and empathizing with people, especially business owners, because I know taxes are stressful. Taxes can be very stressful.
Yeah, for sure. That's definitely a good skill for a tax preparer. So, there's so many different things that you're always learning in your profession. How do you keep your skills sharp?
Well, it is tough. We have first of all, we have an absolutely amazing team in our private CPA firm that's allowed me to do some more outwardly facing tasks. And about 10 years ago, I thought, you know what? You really don't know something until you're forced to teach it. And then not only teach it, but teach it to your peers. So for me to have to, like this OB3, then we talked about this for an hour. We've got a 16-hour 2-day course that I'm one of 6 or 7 or 8 teachers for a large national tax organization that we're going to go, and we go on the road for a few weeks and teach other tax professionals. So I could sit in the classroom and just learn it, but I feel like if I put myself in the hot seat and force myself, get on an airplane, I'm flying to Boise, Idaho to teach 100 other accountants 2 days, all this stuff, forces me to learn it. So yeah, that's how I stay sharp. And there's always things. The dirty secret is I actually learn more from the attendees than they learn from me. But that's how I stay on top of things.
Very nice. What's the one book that you recommend that's been very transformational for you?
Oh gosh, there's a lot of them. Who Not How. That's probably
I like that one. Yeah, that's a great one.
And then I'm just started The Science of Scaling by Dr. Benjamin Hardy.
Okay.
Brand new. I'm like, yeah. Recently had to take a long drive to Michigan from Tennessee, and I was going to fly, but it was a real quick trip, unexpected trip. And I told my wife, I'm driving. She's like, why don't you just fly there? I'm like, I got a book I need to listen to. Part of the reason I intentionally drove when I probably could have flown. I wanted to save that much time by flying. And I'm just getting into that book right now.
Okay.
Yeah.
That's a good book too. I finished that one. I think.
Oh, nice.
Twice already. All right. So you're in the Nashville area, right?
Yes.
What must eat spot would you recommend if any of us ever visit?
Well, I would say, that's a really good one. Now I got the palate of like a 5th grader, but that's all right. If you're in Nashville, you're going to need some barbecue or some hot chicken. So I'm saying Hattie B's is my favorite. There's a couple of them. Hattie B's is my favorite hot chicken place. So I would go to Hattie B's. And if you like sports, they've got TVs. But yeah, I've yet to have someone disappointed in that.
Yeah, no, you can't go wrong Hattie B's. I tried that one. That's actually one of the really good ones.
Yes. It's just a little better than that the fast food place that now says they have Nashville hot chicken on the side of the interstate.
All right. So last thing here, if people want to connect with you, follow you, stay in touch with you, what's the best place to do that?
Right. Well, first of all, I'd be honored if you did. I have a very unique name. So if you just Google me, you're going to, where I'm on, Facebook and LinkedIn and stuff. But if they, in Teaching Tax Flow, my t-shirt, our Teaching Tax Flow YouTube channel is a great follow, subscription, or just subscribe. It's free. We're putting tons of new content out there. We have a whole playlist just for OB3. If you're interested in working with myself and our team, you could submit an inquiry. Just go to 2025.tax, and it's about 5-6 questions. And then we'll reach out and set up a personalized 10 to 15 minute chat. Just talk about your situation. I'm happy to help guide you in the right direction.
Awesome. And just a question real quick. We got 3 months left, right, for the end of the year. Is that still enough time to talk to a person like you to wrap things up?
Yeah, I mean, yes, there is time. And there's some things you could do after the end of the year. So depending on your situation, and there's still time. There's still time. On the private, and if we end up getting to capacity, which depending on when you listen to this, it's going to happen before the end of the year. I'm going to help guide you in the right direction. One of the blessings of being able to work with other tax professionals and being in an education capacity is that I know the people that care. And if I meet someone that I said, gosh, maybe you're just not the best at like networking and stuff, but you're a really good accountant. You're a good person I'd want to work with. I'm happy to send a referral to that person. So you'll be in good hands.
Sweet.
All right.
Sweet.
All right, Johnny, you want to wrap up the show?
Yeah. So that kind of concludes our show. But Chris, man, thank you so much. You laid down so much information for us. And we'll definitely have to have you come back. I think there's going to be, a lot of real estate investors that are going to be watching this, and maybe next time we'll do a real estate investor one specifically. And so, I can't thank you enough. The moment that I reached out to you, you were like, yes, right away. And so that means a ton. And, I look forward to doing business with you, and let's keep going. And, if there's anything that you need, just feel free to, pass it along, and we'll push it out as well.
Oh, I appreciate it. And yeah, absolutely. I look forward to being back. We'll dive into some of these things, and it's been an honor. And thanks again.
All right.
All right. Thank you, Chris.
All right.